All right. Well, I'd like to start off by thanking everyone for joining this. Really appreciate having you taking the time out of your day to join us. I will be circulating a recording and the slide deck for this presentation after we're completed here. It shouldn't take us all the time that we've allotted, maybe 20 minutes or so, but we will go into some detail here for you. And yeah, so the presentation today, just to start off, I'm Rob Ruff. I am the Vice President of Strongpay. I've a fun fact, I started as a temp here and worked my way up to Vice President over the last 19 years. So I'm happy to be here with you today and share with you about Secure 2.0 Roth catch-up for highly paid individuals and what you need to know for payroll specifically. We'll cover kind of both sides of the coin here today in terms of payroll and 401k. So we're going to cover who is affected and what rules are changing and how we're automating everything on Strongpay's end from a compliance standpoint so that you don't have to do much of anything on your end. It's automated. We're taking care of it for you. So what exactly is changing in 2026? So beginning January 1st of 2026, highly paid individuals, also known as HPIs, must make catch-up contributions as Roth. That applies to 401k, 403b, and 457b, with the exclusion for 457b of the 3-year catch-up, special catch-up before retirement. To make that clear, this change just affects the tax treatment of the contribution, not the eligibility of that person to participate. Although technically, if you do not have a Roth on your plan, we'll get to that shortly, you can't contribute catch-up contributions if Roth, and if you are an HPI and you get in that situation of deferring to catch up. Strongpay will manage this transition for you automatically, and we've got you covered. So how does that look? And what's an HPI specifically? The IRS is defining that as an employee that has received in 2025 $150,000 or more in Social Security wages. Then in the 2026 plan year, they are considered an HPI. Then if they have catch-up contributions, those catch-up contributions must be made as Roth, not pre-tax. Some important things to distinguish between here. HPI status is determined per employer, not across multiple jobs, not across multiple companies. So if you're a new employee this year, you cannot be an HPI this year, but potentially next year. If you need Social Security wages, so if you have a K-1, you're an owner, SE wages or income, you have to have Social Security wages to become an HPI. And then only HPIs themselves must be treated as Roth for catch-up. You could not be an HPI, make less than $150,000 a year in Social Security wages, and you can still contribute pre-tax. So take a little step back here. What is a catch-up contribution and what are they for 2026? The standard catch-up for employees or participants age 50 and older is $8,000. And that's above the standard IRS limit of $24,500 for 2026. For HPIs, that $8,000 must be Roth. However, there's an enhanced catch-up for those ages 60 to 63. That is $11,250 compared to $8,000 for anyone else over 50. Additionally, the enhanced catch-up, this limit also needs to be Roth. So that extra $11,250 or really $3,250 additional from the typical Roth or typical catch-up needs to be made as Roth if you are an HPI. And then Additionally, a note I wanted to make is a catch-up is a limit. It's not an actual source. It's not a deferral source. There's Roth, but the catch-up itself is not an extra deduction code in payroll. It's not like a separate container. It's not something you really opt out of or say, I don't want that. It's all controlled through the contribution form. And so it's in the hands of the employee. And it's also based off, obviously, on age and year-to-date deferrals. But catch-up occurs automatically once that IRS 402G annual limit is exceeded. That's $24,500 for 2026. And we track this for you based on your birth date and your deferral history. All right. There's one thing here that's important to understand. So if an HPI already contributes to Roth, those Roth deferrals can be used after you reach the 402G limit. Essentially what I'm saying here is you can take credit for Roth contributions earlier in the year once you get to your catch-up, once you get into the catch-up limit. So it allows you to take credit for Roth throughout the year if you're contributing to Roth already. So we can go into some examples here shortly, but this gives you an idea that the pre-tax deferrals can stay pre-tax up to the IRS 402G limit, and the catch-up portion must be treated as Roth. However, if you have Roth deferrals previously in the year, you can take credit for those contributions after you've passed the 402G limit. Employees don't have, that means then some employees don't have to change their limit or elections mid-year. In fact, no one has to change their elections if they don't want to. This is all automated on our end. However, we'll get into that. This will be part of the FAQ because employees may opt out of it, but they will do that through a contribution form through the record keeper, however they make their changes in payroll for 401k. But this also means that payroll teams don't have to reclassify contributions mid-year as well. Let's go through an example. Meet Patty. She's an HPI and eligible for catch-up contributions. She is not between the ages of 60 and 63. She elects $600 pre-tax and $600 Roth per pay period on a semi-monthly basis. That comes out to, for the year, $28,800. This assumes a 402G limit for 2026 is $24,500. Total deferrals exceeding the limit are $4,300. So that $4,300 must be Roth catch-up. One thing I want to mention here, this isn't a view of payroll by payroll contributions. This is looking at it as like an annual figure. So the mechanics of it will look a little different, but for demonstration purposes, I want to drive home what's happening here. So Patty's already contributed $14,400 of Roth throughout the year already. So the $4,300 existing Roth is treated as catch-up, and her full $14,400 pre-tax remains the same. So this goes back to that previous slide of she's deferred Roth throughout the year and deferred more than the catch-up limit that she's received. So she already takes credit for Roth. There was no conversion, and she's compliant. However, let's meet Benny. I don't know if Benny and Patty know each other, but maybe. HPI, he's an HPI. He contributes $1,250 pre-tax bi-weekly, not an enhanced catch-up as well, not between the ages of 60 and 63. And he contributes pre-tax deferrals total of $32,500. Benny has fully contributed to his pre-tax 401k with the 402G limit and with catch-up. As a result, though, because he's fully pre-tax, that $8,000 must be Roth catch-up. So when Benny's limits and payroll start surpassing $24,500, they will automatically in Strongpay trigger over to Roth catch-up. or just Roth. Because as I said, catch-up is a limit. It's not a actual source. And because Benny did not make any Roth contributions during the year, he has no existing Roth dollars to reclassify or take credit for. And to comply, we must add a deferral of Roth to correctly categorize the excess 8,000 as Roth catch-up. And pre-tax can't be used to satisfy catch-up in this instance because Benny's an HPI. So what employers and plan sponsors need to know: only HPIs are impacted by the Roth rule. So standard retirement contributions do not change. So if your plan does not allow for Roth, I spoke about this earlier, but HPIs cannot make catch-up contributions if you do not have Roth, if and only if you are an HPI. Non-HPIs still can participate in catch-up and do so pre-tax. What Strongpay handles is the HPI identification for you. We have the payroll data to look at and identify for you. We monitor catch-up limit tracking. We do that already. And we can manage a Roth application and matching and mapping. And we are also doing data validations. So that leads us to the next slide here of what we're really doing for you. So we read the prior year FICA wages. We classify HPIs automatically each payroll year. There's no setup on your end. We handle it for you. And then we map the pre-tax deferrals to the Roth deferrals in the system for you. We do that behind the scenes so that when the catch-up contribution occurs, we can automatically apply the Roth catch-up instantaneously. And then the Roth first logic, so you can take credit for Roth contributions earlier in the year. So we don't have to manually switch back and forth. Missing data overrides. So in the instance, like for instance, new clients, we don't have your previous year of data. So we have a flag that you'll be able to check off to treat an employee as an HPI for X tax year. So say 2025 for next year. And then again, just some data validation. So we have HPI misclassifications. We're looking at deferrals year to date, limit exceedances, and we're working to protect you however we can to prevent any other unexpected surprises at the end of year. All right. I've built in some frequently asked questions. There's a lot here. Some of this is repetitive, and some is not. So do normal pre-tax contributions change? No. So only catch-up amounts are impacted for HPIs, and the participant doesn't have to make that change. They don't have to do anything. It will just happen. And can an employee opt out of Roth catch-up? No, not necessarily. The IRS requires Roth for HPIs, but an employee can change their election. They can stop contributing if they don't want Roth for whatever reason it might be. So they're in the driver's seat of their own destiny. If an HPI opts out of Roth, how do we stop catch-up contributions? In the payroll system, there's one thing you can do. If you want to take the driver's seat as an employer, you can set a year-to-date max on their contribution. And as a courtesy, we look for that year-to-date max. Say it's 24,500. We look for that, and every year we will update that based on the IRS limit changes. So when the 402G limit changes, we'll go through and make those changes on deduction records to make sure that the year-to-date max is in compliance. The employee additionally can make their own changes to their contribution and update an enrollment form and stop their contributions. They'll want to, if they want to continue contributing the following year, they will need to submit an additional enrollment form to re-enroll back in. That's an important note to make right there. What about employees with two jobs? An HPI status is based on an EIN, on FICA wages within that company only. So if you have two jobs, unless you're surpassing the wages in both of those jobs, you will not be treated any differently, or if you are in one versus the other. So again, it's within each entity is how this is calculated and factored, triggered, applied. What if we don't have prior year data? There's an HPI override option for that. Do I need to get prior wages for new hires? No HPI status per company. So new hires would have $0 in wages in that prior year. Does this change employer match? It has no effect on employer match. So that's good news there. One less thing to worry about. If an HPI already defers Roth, as we said, an HPI already making Roth contributions can take credit for those Roth contributions, even once they're crossed the 402G limit into catch-up. There's no separate catch-up Roth election. And what if your current plan doesn't offer Roth? So plans must allow Roth if they intend to offer catch-up contributions after 2025 for highly paid individuals. The highly paid individual catch-up contributions cannot be made if Roth is not permitted in your plan. So I would recommend amending your plan to allow for contributions if you have not already, or if you do not have them, if you want your highly paid individuals to contribute catch-up contributions. So contact your 401k plan TPA for this option. How will employees know they reached the catch-up limit? So again, the payroll automates all this, identifies an employee's year-to-date elective deferral, monitors the 402G limit against the birth date. Once contributions go past that 402G limit, the amounts are made as catch-up, and if they're an HPI, they'll become Roth catch-up. So this is a big one. Do we need to notify you if we do not have Roth in our plan? So if you have a Strongpay Partners TPA, you do not need to notify us. We will coordinate with your plan TPA ahead of time. So we'll already have it configured for you, do everything for you in the background there. If your plan is administered outside of the Strongpay network, I would say yes. Please notify us, because we are going to assume if you have a Roth deduction code configured on your payroll account that you have Roth on your plan, and we'll make that mapping. So it's an opt-out. I would call it an opt-out because it seems most employers are adopting Roth into their plan as compared to the other way around. And if you do not have payroll with us at all, just please notify your payroll provider. Communication is key. And does an employee have to elect Roth? No, you don't have to. Again, they can be regular pre-tax deferrals. It'll all be automated in the background for you. All right, so key takeaways. Again, we've covered a lot of this in spades here, but HPIs, again, $150,000 or more than $150,000 in Social Security wages in 2025. That is actually indexed each year, so that amount limit will change annually. And those individuals must make all catch-up contributions as Roth from a year-to-date perspective. The standard catch-up for 50 plus is $8,000. The enhanced catch-up for 60 to 63 is $11,250. Catch-up is a limit, not a deduction type. Roth contributions can satisfy the required catch-up, and employers and plan sponsors do not need to manage the mechanics manually with Strongpay because we automate that HPI identification, the catch-up tracking, the Roth application, and do validations. So with that, I'd like to bring to a close and thank you. If you want to stay ahead of regulatory changes, we are posting on LinkedIn quite often. This QR code is for our LinkedIn page. And we provide payroll and IRS updates. If you have further questions that you'd like answered or any other question you might have, email us at payroll@strongpay.com. And with that, I thank you very much for joining and for your time and attention. We really appreciate it, and have a great day. Thank you.